Hello, my name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me in the Financial Advisors Register, linked in the description box below. It's important to know that all my content is general in nature and is considered general advice only. That means it's not specifically tailored for your personal financial situation. So if there's anything that you want to investigate further, always seek out the opinion from a qualified financial advisor to make sure that it's appropriate for your financial situation. Also, my financial services guide is available to download from the description box below. Investing your money can be one of the best ways to grow your wealth, but for some people it can feel risky. What exactly is investment risk and how can you manage it? So first things first, investment risk is the chance that the value of your investment can go down instead of up. Some types of investments feel like it's smooth sailing, and other types of investments can feel pretty unpredictable. Investing carries some level of risk, which can lead to investment market volatility, and risk and the probability or likelihood that your investment will move around in value can come from things like changes in government policy, a changing economic environment, or unexpected global events such as COVID in 2020 and the 9/11 terrorist attacks or wars. So why do we take risk? If risk means that you could see your money fall in value, why do we even bother? And that's a really good question because increasing risk does mean there's a higher chance of experiencing greater ups and downs in the value of your investment. But avoiding risk entirely usually means avoiding opportunity too. Taking some risk is how we give our money a chance to grow. For example, investing in the share market is riskier than keeping your money in a savings account. But over the long term, quality shares tend to grow your money faster. It's all about striking the right balance between risk and reward for your goals. This graph shows the risk and return relationship for different asset classes. The timeline along the bottom is risk, and the left side is low risk. Investments are more stable and don't move up and down much, just like cash and term deposits. So right now, cash and fixed interest are generally low risk and generate lower returns. But you might ask, well, what about bonds? Well, they are fixed interest and not necessarily low risk, and that is true. Some bonds are quite stable, but not all bonds are low risk. Just like there are safe cars and fast risky cars, there are also high risk and low risk bonds. So while bonds fall under fixed interest, that doesn't mean that they're always smooth sailing. It depends upon who issued the bond, how long it lasts, what's happening with interest rates. Even keeping money in cash has risks like inflation eating away at its value over time. The right side of the graph is higher risk, and the investments on this side can go up and down a lot, and generating higher returns, which is what they do on the right-hand side, but also drop quickly too. So if you want higher returns, you need to accept more ups and downs. If you prefer stability, your returns may be lower. That's the risk-return trade-off, trying to find the right balance based upon your comfort level and your time frame. It's understanding what level of risk is right for you and managing it wisely rather than avoiding it altogether. So it's really about balancing the risk that you take with the goals that you're trying to achieve and making sure the returns are realistic. So always step back and don't rush. There are different types of investment risk, and some of the types of risks you need to know are, for example, changes in foreign currency values. This will affect investments that you hold in foreign currencies. For example, you've invested in European stocks, but the Australian dollar strengthens against the euro. So even if the stock performs well, your returns can be lower when converted back to Australian dollars. Also, changes in government policy, new laws, or political instability can affect your investments. For example, a government introduces strict environmental regulations that increase the costs for energy companies, causing their stock prices to drop. Sometimes selling an investment quickly can mean taking a loss because there's no buyer at your offer price, which is called liquidity risk. Concentration risk as well, that's a common one. This is where you may have too much invested in one asset class or sector or region, which is also called a lack of diversification. For example, you invest in only tech stocks and then the tech bubble bursts, and then your portfolio suffers big losses because you weren't invested across other industries. We know there's no guarantees with investing, so how can we reduce risk? Diversify your investments. This means don't rely upon only one investment to do all the work. Spread your money across different asset types and industries and regions, and then diversify within each asset type. For example, for your Australian equities exposure, don't just buy 5 Australian equities. Consider investing in 50 plus different Australian companies and different industries and regions to achieve a real market exposure to that asset class. You can also do this through broad-based exchange-traded funds or a managed fund that tracks the Australian share market. So know your time frame, and if you're investing for the long term, you're in a better position to ride out volatility, assuming you're invested in quality investments. If you haven't got time on your side, think carefully about investing your money and make sure you can get back your money if you need it. It's important to know how long it will take for you to get access to your investment. For short-term goals, lower risk investment options are better. Consider investments like a high-interest savings account or a term deposit. These investments are lower risk as they're less likely to fall in value. Match investments to your risk tolerance. Some people are comfortable with volatile investments, whereas others prefer stability. So choose what's right for you, do your research, and understand what you're investing in so you're prepared for potential ups and downs. Also know the cost to buy and sell. So how do you know what your risk tolerance is? Let's quickly talk about it. Your risk tolerance is how comfortable you are with your investment going up and down in value. For example, younger investors with decades until retirement might have a larger portion or a larger exposure to the share market for greater growth, while someone nearing retirement might have a greater proportion of their funds in defensive type investments like bonds and annuities and term deposits for stability. Remember, there's no one-size-fits-all approach. Here's the key. Risk is a natural part of investing, but understanding and managing it can make all the difference by managing your comfort level, by knowing your goals, your time frame, and choosing quality investments and diversifying them across different asset classes and within asset classes, plus staying informed. You can help pass that sleep at night test. And that's where you want to be. You want to be comfortable that your investments match your comfort level, but you don't want to be in the position that you actually take no risk. If, for example, being so worried that you leave your investment portfolio in cash. Leaving it like this would mean that you're actually going backwards. Fees, charges, and insurance premiums, if you have insurance, would erode your balance, and the interest you may receive from your cash balance won't make up for that. So when it comes to your super, this means that you may, in time, need to delay your retirement because your balance is just too low. Next time, we'll be talking about the myths of investing and the psychology behind common investing mistakes. So if that's something you're interested in, subscribe below. In the meantime, if you have any questions or you need personalised advice, don't hesitate to reach out to a licensed advisor or your super fund. Until next time.